Hey there, community bankers. Welcome back to the Correspondent podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Kaplinger, Marketing Specialist for ICBB. The end of 2025 and beginning of 2026 have been eventful for the economy, to say the least. For our first marketing update episode of 2026, I've brought back our CFO Chris Dew, Chief Lending Officer Brandon Feltner, and Scott Kimel from our partners at FNBB Capital Markets. Please welcome Chris, Brandon, and Scott to the podcast. Hey there, community bankers. I am here with our CFO, Chris Dew, our Chief Lender, Brandon Feltner, and Scott Kimel from our partners at FNBB Capital Markets. How are you guys doing today?
Doing
Great, thank you. They're good.
Awesome. Well, thank you guys for joining us today. Like I said in the intro, it's been a pretty eventful end of 2025 and beginning of 2026. So this market update episode, we're going to have a lot to talk through. But to start, we'll just kind of start with financial markets. So how did the financial markets actually pan out in Q1? And beyond the headlines, what were some of the fundamental drivers that caught people off guard?
Well, from the on the economic side, domestic front was definitely showing some signs of softening going into January and February. We had very weak consumer confidence numbers. Obviously, the disappointing jobs number at the end of February, and in terms of interest rates, the markets had essentially priced in 2 cuts by the Fed going through the end of this year. That obviously all changed mid-morning on February 27th when the situation with Iran kind of came unwound. And since then, the markets have strictly been driven by headlines and news and social media tweets that have come out on a daily, if not hourly basis. And everything is being driven by that right now. And so all of the interest rate projections, stock market projections have all basically been revolving around that, with very little else being factored in.
Right. Yeah, I would just say from a lending perspective, I think things started out strong and optimistic for the new year, but with the war, I think it's really kind of cooled things off, and folks are more optimistic now than perhaps they were before. So it's kind of sidelined some lending activity, I feel like, to see kind of how this unfolds perhaps throughout second quarter and kind of where this war takes us. I think it's where a lot of consumers and investors are right now.
Yeah, just as an example on interest rates, looking at the 5-year Treasury, which is kind of a good proxy for a lot of banks' investment portfolios. The 5-year Treasury on the morning of February 27th was down at 348, below 350, which was pointing towards the short end of the curve, yields coming down. Since that time, early this morning, it topped out at 409. So again, since the 27th, basically in 3 weeks, we've seen what would normally be almost probably a yearly move in the 5-year Treasury, 61 basis points up. Right now, it's dropped 15 basis points just today, again, based on conflicting social media tweets by the president, and we're at 394 right now. Kind of getting myopic for just a second and looking at just bond portfolios, I would caution everybody that is listening to this in real time or in the next day or so to be very cognizant that bond accountings this month are going to be fairly shocking, because again, we priced bonds last month on I think it was February 23rd or 24th, and yields across the curve are up about 50 basis points just in the past month. So just something to be aware of, be kind of mentally and emotionally preparing for. Hopefully when this thing settles down and resolves itself one way or the other, we'll start to see a move back to normalcy. But right now, it's just extremely volatile.
Right. And mention of oil prices, it's a good segue. Obviously, the conflict in Iran is having a major impact on oil prices, which drives a lot of our economic activity, not just here, but globally as well. And people are definitely feeling that pain when they go to the gas pump. But beyond that, what kind of second order economic impacts should community bankers be watching for in their portfolios? I know you mentioned bonds, Scott.
Well, I think commodities are going to be felt very, very quickly. I forget the exact percentage, but a large portion of the world's fertilizer components come out of that same area. And we're already hearing reports both globally and domestically that fertilizer and chemical prices are skyrocketing, not necessarily as fast as oil did, which is pretty much immediate, but are seeing, huge input costs for crops and things as a result of what's going on in the Persian Gulf and specifically in the Straits of Hormuz as well.
Yeah, well, and it's the cost of it, but also the access to it. I talked to a couple of farmers over the weekend at a visitation and made the comment that they're a little bit concerned as to whether or not they're going to be able to get all of the inputs that they really needed. They were kind of waiting to buy some to kind of play the timing game a little bit, and they're regretting that decision to some degree. I would second what Scott said. It does go beyond. The other thing we have to think about is it impacts at the gas pump, and so it's obvious that it's going to impact the cost of transportation. Everything gets shipped at some point in time. The other thing is the number of products that we regularly use, whether it's in manufacturing or just household use, that are petroleum-based products is tremendous. So as far as the second level impacts, there's probably no way to measure it because, again, fuel is going to impact everything, whether it's something that's petroleum-based or it's just something that ships, whether you're shipping on a semi-truck or a cargo, ship, or even a train, you're running on some form of fuel. And I do think that's something that a lot of the banks need to be paying attention to on their commercial portfolio is understanding, what kind of breakout they have for businesses in there. 1 to 4, I read a study once. I wish I could remember the number because it actually surprised me. The percentage of a 1 to 4 family home that is constructed with petroleum-based products, it's a lot higher than you think. Most people think it's all wood and metal. But a ton of the products used to construct a 1 to 4 family home are petroleum based. So, that's going to have a big impact if you're a bank that deals heavily in the construction world. At the same time, if you're one that says, "Oh, I'm offset, I'm out of the construction, I'm over here in the C&I world, I've got more industrial and manufacturing, things of that nature," they're buying products from overseas, they're shipping products all over the country, they're moving things around. The impact is going to be huge for all. And the ability at this point with where we are in our overall economic cycle, the ability to push that additional cost forward, I think we're reaching the point where that's going to be much more difficult. So I do think understanding the exposure that you have in your commercial portfolio is going to be very important.
Yeah.
Yeah. Chris's point is spot on. I'm talking about the pricing, but the underlying factor to that is Chris's point about availability, and essentially what we're doing now is basically doing the same thing that happened during COVID, and we're breaking and disrupting a lot of very, very fragile supply chains.
Mm-hmm. Yeah, I was just going to add, I think, just given all the things said by both Chris and Scott, just the disposable income for Americans is shrinking, and it's making things tighter and tighter.
Right, for sure. I mean, it sounds like, we were already feeling this pain at the pump. I think a lot of Americans have been feeling, pinch in other areas for a while, but it sounds like it's going to spill over into, feeling the pinch from this particular conflict at, the grocery store and at restaurants and, at Walmart and things like that, which is obviously going to have an impact on our community banks and their cash flows and their lending activity and all those things as well. So kind of continuing on the geopolitical trend, the Supreme Court recently struck down tariffs but the administration immediately countered with a 15% global tariff. And I'm certainly not qualified to assess how that stalemate, who has the upper hand in that stalemate. So without getting into legal weeds, how does this trade volatility affect our commercial borrowers' ability to plan for the year? I mean, we've already been talking about other areas of uncertainty, but what about this one?
I think the tariffs prevent, borrowers from really anchoring down on, a stable cost structure, making it more challenging to plan effectively. It's hard to determine your gross margin, when you don't know your cost, right? For most bankers, this makes question the borrower projections and, their credibility to achieve them. Also, loan covenant pressure due to the increased volatility. And then, I think it could make good borrowers look temporarily weak overall. And I think the real impact will be just delayed investments and, strain on working capital and somewhat unreliable forecast, and then margin pressure.
Yeah, I would agree with that. I know I've spoken to a few business owners that have said that, they theoretically built in the impact of tariffs into what they projected for this year. But with the change now, it kind of reopens the door, and several of them have brought up they wonder how many of the trade deals that had previously been negotiated are now going to hold, whether that benefits them or it harms them. Because again, if they don't hold, then there may be a chance that the negotiated rate comes down a bit. But on the other side, if they, it could always go the other direction. So just the uncertainty, I think, is just starting to weigh on a lot of folks, and the difficulty to be able to project and manage your cash flows is very high. On this front, though, I will also point out something. I know we'll continue to talk about interest rates, and we'll probably go a little deeper in a little later. But one of the things that hasn't really been talked too much about is that whenever the Supreme Court knocked down the previous tariffs, there's this question out there about refundability of the existing tariffs that have been collected. And what a lot of people don't understand is that, the pressure that would effectively put on the U.S. government, or at least the Treasury rates, if the U.S. government has to pay all that back, they have to borrow the money to do it. It's not just sitting there waiting to be refunded. So there's a process that has to be gone through, but the pressure that would apply on the Treasuries would definitely be upward, because they're going to have to go out and place a lot more bonds out into the market to be able to fund paying that back. Now we'll see how all of that unwinds over time. Scott may have more on that than I do, but I do think that's something that everybody's got to be cognizant of. It's almost like it's partially, I would say it's at least partially priced in right now to the market, but it's almost like it's something that's kind of hanging out there that could be another upward shock to rates.
Just adds to the mounting, and I would use the term unprecedented uncertainty. You've heard me say it 100 times, but the market hates bad news, but it loathes uncertainty. And so, to your point about timing, I think a lot of CapEx and a lot of projects will be put on hold indefinitely, pending some sort of clarity going forward. And and it's any of ours guess as to when that might be.
Now, and I think you're right, and I think that's unfortunate. Is this the first time in the episode we've used the word uncertainty?
It could be. It could be.
It might be.
We've made it deeper in, I think, than we normally do for uncertainty to come up. But
exactly.
No,
I've made the remark before.
I've heard it several times.
I know we've alluded to it. Maybe the actual word depends on who's playing, the drinking game I once proposed as to, does it have to be the word uncertainty, or does volatility count, et cetera. Yeah, but kind of shifting gears a little bit, but continuing, you mentioned the Treasury, but Chairman Powell's term as head of the Federal Reserve ends in May. And Kevin Warsh has been nominated to succeed him. I can't say Warsh without thinking of my Eastern Kentucky grandparents who said Warsh rag and Warsh this, Warsh that. I don't know about you guys. But we're seeing a mix of kind of inflation hawk history out of him, but more recent dovish signals. I know he was a big part of the Federal Reserve through 2008 and through like 2011, and that era kind of maybe changed his stance on some things from what I've been reading. But given the pressure for rate cuts that's been coming to the Federal Reserve, what's the best way for community banks to model their interest rate risk during this upcoming transition?
There's talk now that he is pushing back a little bit on leaving his post while and he's obviously getting his legal advice while the subpoenas and everything are still hanging out there against him. But when you're talking about modeling your interest rate risk, I'm going to sound a little bit like a broken record today. And again, that's probably changing, if not day by day, but hour by hour. And it goes back to our earlier conversation about everybody just kind of sitting tight, whether it's capital expenditures or construction projects. I think you're going to see a lot of people sitting on their hands right now and winding their watch, so to speak, until there's some sort of clarity. And I'm going to interject a little opinion now. I don't foresee that coming for quite some time.
Calling all of our community bankers in the great state of Tennessee. We're coming to you on Tuesday, June 30th for Link, Leading Insights, Networking, and Knowledge. Join ICBB for a day of learning with your community bank peers. You won't want to miss presentations like Agentic AI 101 for Banking Leaders by Angela Murphy from Pigeon, Tackling Check Fraud by Brian Hoffman from Finovify, What to Do with Canadian Checks by Dan Caputo from Ascendant, and a presentation on FedNow from the Federal Reserve. Register now to save your spot at the link in our show notes. We can't wait to see you there.
Yeah, and I think to kind of piggyback on what Scott was saying, one thing to think about is you don't change your strategy because there's a change in regards to the leader at the Fed. And one of the big reasons is whether it's Warsh or Powell or anyone, one person doesn't get to make the decision on interest rate changes at the Fed. That's one of the great things about the way the model is set up. You have an entire committee, and typically, historically, that they've had a lot of unanimous decisions on that committee. They talk about this in depth to make sure that there's continuity of thought. And I'm not saying he won't try harder to get rate cuts, but he's going to be up against several folks who are probably going to disagree with him, at least for the foreseeable future. So once he does take the seat, I still wouldn't change my model based upon that. I'll also say that, I came into banking 20 years ago, and one of the first things I was taught, because I 20 years ago was when I started on an interest rate risk committee or ALCO committee. And one of the first things I was taught was we do not bet on interest rates in banking, which seemed kind of strange to me because it's like, well, that's kind of what we do. That's our model. But that's true. We shouldn't be crafting our interest rate risk model based upon where rates are and where we think they're going. We should be crafting our interest rate model to build a balance sheet that is a stable balance sheet with a proactive purpose, but the ability to be reactive if and when we need to. And so that is really a long-term play. And so you need to be building this out in a way where, if you've already determined that the way my balance sheet looks and performs at its best is a certain mix of, loans and cash and securities, and I want to mix in regards to short versus long-term and structures, et cetera. If you've built that out, you continue that path forward. You continue to manage that and be prepared to mitigate whatever may come. So now, would I want to be taking really long positions right now that assume everything's going to hold steady and hold flat? Probably not. But if it fits into my overall balance sheet, then I'm going to continue to deploy that strategy. Definitely not for one person, but even for the kind of the volatility and everything we have in the market today, I wouldn't be making major shifts. I will say I think we're reaching the point where I've heard more people start again to talk about hedging and some derivatives and things like that. But I typically only recommend those if you've built a balance sheet that is really lopsided. So if you're carrying a lot of risk in regards to interest rates, that's when we start looking at those things. But beyond that, if I've got a good strategy, I would continue to deploy it.
Yeah, I would agree with that. And, just on the lending side of how what I'm seeing play out is I would say more variable rate loans is kind of what we're seeing on the participation side. Of course, the credits that we're seeing, larger deals with just, a floor and a ceiling in there. I don't know. We've had any fixed rate loans in the past. It seems like 12 months. It seems like everybody wants that floating rate with the ability to take the ride down, but not really, the collar, I guess, as far as the ceiling, not to be, too high either, because way rates could go.
Right. And I think that's really great insight as well. I've, in the kind of research and study I've been doing to prepare for this podcast and kind of understand what's going on, I've come to understand that when geopolitical tensions rise, like what we're seeing, there's this natural migration of capital away from higher risk investments into the perceived security and stability of our banking system. So first of all, are you beginning to see that? And second of all, is that influx of capital actually strengthening balance sheets right now? Or are, the rising costs and the tariffs creating a cash flow gap for borrowers that we might need to be worried about?
At the bank level, you're definitely seeing it. Obviously being a correspondent bank, we know what the liquidity levels are in the system, and I can tell you that they had, they kind of trickled off a little bit. They've started to show that some of the liquidity was shrinking a little out of the system, which for the most part was banks redeploying that liquidity. It has come back full force over the last 45 days. It actually started coming back a little bit prior to Iran. It has ramped up since then. And I can actually say anecdotally, so I've had two conversations in the last week and a half or so with some business owners that they stuck out to me. They basically said the same thing, but their reasoning was very different. They both admitted that they are effectively hoarding cash, both at their business level as well as their personal level, which was consistent, but their reasons were complete opposites. One basically said that he was so concerned that he was going to need that dry powder. He brought up concerns over market risk and equity risk. He brought concerns up over his business cash flow capabilities, that there was a major pullback and he had to, self-fund it for a while. He was like, I'm nervous about, having all this excess cash or not having this excess cash to fall back on. The other one said that he was intentionally kind of building up a cash, balance because he saw opportunities coming in the next 6 to 12 months. And he actually referenced back and he said, I made a lot of money during the financial crisis because I had cash when nobody else did. And so he's hearkening back onto that. He's seeing it as an opportunity coming forward as opposed to the risk associated with it. And I do think that's important for us to understand because I believe most every community bank out there is probably seeing some degree of liquidity build right now. But we have to understand is that we do have different mentalities that are driving it. So when you asked, are they strengthening our balance sheets? On paper, yes. Long term, it's a question mark. Because you take those two gentlemen that I spoke to, the one who's hoarding cash out of fear, that cash is likely to slowly trickle back out of the bank. So his cash hold is going to stay high for a longer period of time because even once he feels like, the risks have gone down, he's still going to be a little bit on edge. He's probably not going to put it to work quickly. The other gentleman is looking for opportunities. And so the first time he sees that opportunity, he's going to pull that cash out and put it to work as quickly as he can. And we have to understand that. And as bankers, that's part of what we do on a daily basis is managing that liquidity position. But when you get in these periods where the liquidity builds in a quick, rate to a high level, you do have to be aware of the risk associated with how quickly it may leave the balance sheet again. And so I bring that up just because it was an eye opener for me as I started seeing all these bank balance sheets fill up with cash. The assumption is that it is the people just trying to, get to more of a risk-free asset, get it in cash, stay safe. And then having that conversation with the other gentleman that kind of challenged that and said, I'm not trying to stay safe. I'm trying to stay, flexible to where I can jump when an opportunity comes up in front of me. So I do think that's important to understand, because then that dictates how quickly we redeploy those assets for ourselves.
Yeah, that's really interesting that they're doing the same thing, but for two different reasons. So where, one person sees fear, another sees opportunity. And I imagine, we'll see that among bank leadership as well, as we often do in times of crisis. I mean, it sounds like there is opportunity to be had if you are, in a good position to begin with, if you're prepared for it and you have kind of assets to fall back on. So looking at our own backyard, how are community banks faring with liquidity and loan performance and things like that? And where do you see the biggest win for a well-positioned bank in the next few quarters?
As far as liquidity, I can speak to that. As I just said, there is a tremendous amount of liquidity in the system right now. So most banks would probably tell you they're holding excess liquidity. Some of them are trying to figure out if it's the right time or what opportunity would, be to put it to work at the moment. Others are holding on to it, as Scott just mentioned. They're holding on to it intentionally because they know the volatility that comes with times like these from a liquidity standpoint. So I would say most banks, at least the ones that I look at, the vast majority of them are strong in a liquidity position right now. But I would also say that I think this is a period where we have elevated liquidity risk. Even though we may be sitting on a ton of it, the risks associated with it are much higher. So, I do think they're making a good decision by doing that. And, I'm certain Brandon will speak to it more in depth than I can. But as far as the loan side of things, I think it's kind of a mixed bag. When you see this much liquidity, you assume that there's going to be a lot of effort to be, pushed towards making more loans. But I don't know that I've really caught that as of yet. So.
Yeah, I was looking on the FDIC earlier and just looking at non-performing loans year over year, and the increase has been rather gradual, but still below the long-term averages. I think it's just a balanced portfolio approach and sound underwriting, sticking to what you are strong in, whether that's commercial real estate or C&I, and really underwriting your credits and mitigating all the risk. You know, Delinquencies are rising on the consumer side. Of course, we don't see that as much on our side or at all because we're a correspondent bank, particularly in commercial lending. But just talking with fellow bankers that are out at the community banks, they have seen an uptick in their delinquencies, in auto loans, credit cards, those unsecured loans, and just, an increased activity and just overdrafts. So, and credit card utilization. So, continue to watch all those things and just, to get a, true handle on kind of where your community is and the economy and how you're going to respond as a bank to serve your clients best while also protecting the bank.
The only thing I would add to that is when you're talking about the delinquencies and credit card usage and things, I'm sure the state average is doing exactly what the rest of the nation is, and it's probably coming from the lower quartiles of borrowers, in line with this K-shaped economy that seems to have emerged.
Right. So for the final question, I know throughout the podcast we've been using words like uncertainty, volatility, and pinch and squeeze. And you may have already given this answer, or you may not have a true answer to this. But from your position as a lender, CFO, and capital markets, what advice would you give community bankers in your position for Q2 to kind of weather whatever it is that we have coming?
I'll go ahead.
Take the most conservative approach. I'll probably take the most conservative approach, and I would say stick to what you know how to do, and that you do well. And I would venture to say this is not the time to go out and try to be experimental or to swing for the fences.
100% agree with that. To extend upon it, I was thinking about this a couple of days ago that. Again, with one of the conversations I was having, somebody went back to 2008, the great financial crisis, and that got my head spinning. And I was thinking about it because of my time in banking. I think this is a period of time, unlike most others, where, kind of some of the core risks that we as bankers have to manage through on a daily basis are at a really elevated state. I kind of look at, I've always been on the balance sheet side of banking. So, I have a responsibility for managing liquidity risk and interest rate risk and also some degree of credit risk. And all three of those right now feel in a very elevated state. For the first time in a long time, we're in a period where technically there is a legitimate risk of interest rates going up and or down at the same time. For most of my years in banking, Scott and I talked about it in one of these podcasts previously, was basically, rates were pretty much at zero and they were flat, and you kind of knew that they were going to stay that way. And even if they didn't, they could only go one direction, and that was up. Now we're in a different scenario, and we've just gone through an exercise where rates were anticipated to go down. And because of, geopolitical tensions, they actually went the other direction. So, being consistent, as I said before, about, building out your strategy and your overall balance sheet management strategy, building that out and staying true to it is probably more important right now than it ever has been, just because if you're facing a period of high liquidity risk and high interest rate risk and high credit risk, there's not really a great place to kind of shift and redeploy. It's more stay true to what you're doing. And as I've said over and over and over again, I do think it is really important to fully understand the balance sheet you currently have and spend some time and effort to go back and look at some of your recent trends, dig in and get some of the data that's within your own system to understand where your risks may lie. Look and see what utilization rates have been, especially on the consumer side, and understand the balance sheet you have from the standpoint of, are there small risks that are starting to bubble to the top that I've not caught yet because it hasn't set off a red blinking light yet, but it's waving a yellow flag in the back corner somewhere. That would be my advice right now, just again, given the state of the overall economy and market.
Yeah, I would just add to that, kind of what I mentioned earlier, just a balanced portfolio approach. Don't try to grow substantially in Q2, and just stick to, what you're good at in that lending space, and really shock your credits. Make sure you're really crossing your T's, dotting your I's with your underwriting, and being mindful of, what the interest rate is going to do to the debt service coverage. And based upon the projections, any rental concessions, there's just a lot of uncertainty out there, and it's going to make sure that you thoroughly understand the deal before you put your name on it. And so I would just be lend, but lend cautiously and mindful of your bank strategy and what you guys are trying to achieve throughout this year, not just in the second quarter.
I will say one more thing I'll add into mine and this is not something I typically advise much unless you're in a position where you need to manage your balance sheet and shrink the bank a little bit to manage capital. Now is one of those times with all the excess liquidity on the books, but also some of that, uncertainty and volatility we've been talking about the entire time. I might potentially be looking at what my wholesale funding side of my balance sheet looks like. And if there are areas where I could possibly deploy some of that excess liquidity to pay a bit of that down right now and basically create some forward capacity. So utilizing some of the liquidity so you're not just sitting on top of it and effectively potentially losing money depending upon your spreads. Instead of taking that approach, possibly looking at dwindling down some of the outside funds, the non-core funds, and manage from that. Now would be a decent time to be considering that. Like I said, typically I'd say lend it out, make your spread, do what we do best. But I do think now is a time to be cautious with that excess liquidity.
That sounds like very sound advice to me. Brandon, Scott, Chris, thank you guys so much for joining me for these market updates. I hope and I really believe that our bankers are going to get something positive and something helpful out of the advice and the wisdom that you're sharing. So thank you so much again for joining me.
My pleasure.
Absolutely. Thank
My
you.
pleasure. Thank you.
Thank you for listening to the Correspondent Podcast from Independent Correspondent Bankers Bank. We hope you've heard something that you can take back to your community bank. Be sure to follow us wherever you get your podcasts. If you're listening on Apple Podcasts, leave us a rating and review, or on Spotify, turn on the notification bell so you never miss an upload. See you next time, community bankers.